Exchange-traded funds have been around for 15 years now, and they're no longer the new kid on the block. They're a mainstream investment vehicle. There's currently $3.6 trillion invested in ETFs around the world, with $19.2 billion right here in Australia. And growth is continuing. Over the past year, we've seen $3.6 billion flowing into the Australian ETF market. Self-managed super funds were the early adopters, and they continue to dominate take-up. And overall, investors now total more than 146,000. So why are ETFs so popular? Well, ETFs provide 5 key benefits that make them a highly attractive investment vehicle when advising clients. ETFs provide a high degree of transparency for investors. Advisors and brokers have full visibility and knowledge of what their clients are investing in, and that enhances conversations. ETFs are as liquid as their underlying constituents. When executing large ETF trades, advisors and brokers can actually request additional liquidity via execution support desks. ETFs are generally low-cost investment vehicles, and that helps you control the expenses of your clients' portfolios. You can use ETFs to create the low-cost core of an investment portfolio and then add satellites in the form of active funds or direct equities. ETFs have expanded into all the traditional asset classes, allowing you to build a fully diversified portfolio from domestic equities through to emerging markets through to international fixed interest. So when you're putting together your investment portfolios, ETFs have a number of practical uses for investors, advisors, brokers, and self-managed super fund trustees. In today's competitive advice landscape, we're seeing advisors and brokers reducing costs for clients with ETFs. Additionally, brokers are building on their Australian equities capabilities and constructing more robust portfolios across asset classes. ETFs have helped brokers broaden their value proposition by making investing in other asset classes as simple as buying individual ASX-listed companies. A diversified portfolio is no longer, say, 20 stocks across 10 GIG sectors. Through the use of ETFs, a diversified portfolio can now be many thousands of individual stocks and bonds across more than 40 developed and emerging market economies, and that complements those 20 previously held ASX stocks. ETFs are very easy to use. However, we should not mistake simplicity with a lack of sophistication. Let's put the magnifying glass on an ETF portfolio for a balanced investor. At Vanguard, we see this as a 50% allocation to income assets and a 50% allocation to growth assets. The income component of this balanced portfolio solution utilises our 2 international fixed interest ETFs, VIF, International Fixed Interest, and VCF, International Credit, to complement a diversified Australian fixed interest portfolio. Fixed interest securities, or bonds, play a vital role in a well-diversified portfolio. They are defensive in nature and they provide capital stability, income and liquidity. Advisors and brokers can now build a highly sophisticated yet simple fixed interest solution, providing their clients with exposure to over 3,800 fixed income securities in just 3 ASX trades. The growth component of this balanced portfolio solution can complement a client's existing Australian equities exposure with international equities and property. By adding VTS, Broad Market US Equities, and VEU, Developed and Emerging Markets ex-US, you gain broad international equity exposure. This can be further diversified with the addition of VAP, Australian Property, and VAS, Broad Market Australian Equities, to complement a client's existing individual stock portfolio. So in up to 7 trades on the ASX, advisors and brokers can layer in over 10,300 stocks. Combining the income and growth solution redefines how we're able to diversify portfolios and execute it in a way that the advisor or broker only needs to keep track of a handful of investment vehicles, and that saves time. Our research is telling us that the average self-managed super fund is overweight Australian equities and cash and underweight fixed interest. This weighting mismatch relative to our diversified managed fund asset allocations provides a great opportunity for advisors and brokers to use ETFs to build more diversified portfolios for their clients. With 2 or 3 trades, overweight, higher risk portfolios can be redesigned with the same researchers' return forecasts in mind, but lower portfolio risk. So taking strategic tilts and rebalancing portfolios are just 2 ways that Vanguard ETFs can help investors achieve true asset diversification. At Vanguard, we know the exchange-traded fund market inside out, with more than $600 billion in ETF assets under management out of a total of $4 trillion around the world. In Australia, we've been serving advisors, brokers and institutions for over 18 years, and we can help you with the conversation. We can provide you with the analytical tools that you need to assess the risk levels in an existing client portfolio and analyse how that risk changes as each ETF investment is added in. We're well placed to help you navigate through the expanding ETF universe and build diversified low-cost portfolios for the long term.